How can the world be falling apart and the stock market be hitting all-time highs at the exact same time? There's a war going on. Inflation is eating through people's paychecks, rent is through the roof, groceries cost more every single week, and the fear of losing your job is real. That's the world most of us are actually living in. And yet, every time you open a financial news app, the market is up, breaking records like none of that even matters. It feels completely disconnected, and honestly, it makes a lot of people think the stock market is just one giant casino, with no real connection to the economy or to regular people's lives. But here's the thing, the real explanation isn't just surprising, it's unsettling. Because once you understand what's actually driving the market higher, you stop feeling confused and start feeling something else entirely. If that question has ever crossed your mind, hit that like button and subscribe. Because this channel is where the stuff mainstream financial media never bothers to explain actually gets broken down. And drop a comment below. Does the stock market feel real to you or completely disconnected from your life? Most people were taught to think about the stock market the same way. When the economy is doing well, stocks go up. When things fall apart, stocks go down. It sounds logical. It feels intuitive. And that's exactly why it's so dangerous, because it's not really how it works. And believing it keeps you from ever truly understanding what's happening with your money. Here's the uncomfortable truth. The stock market isn't a happiness meter. It's not a measure of how regular people are doing. It doesn't care about your rent, your grocery bill, or whether you feel financially secure. What the market actually prices is a very specific set of things: future corporate profits, interest rates, where large amounts of money are flowing, and what traders are being forced to do at any given moment. That's it. Those four things drive the market far more than the actual state of the economy. And here's where it gets even more personal. The stock market isn't a broad reflection of the economy as a whole. It's mostly a collection of large, publicly traded companies, and not even all of them equally. A tiny group of massive corporations carries a disproportionate weight in the index. So when you hear that the market just hit another all-time high, that might have nothing to do with small businesses surviving, workers getting ahead, or families feeling more financially stable. It might just mean that a handful of the most powerful companies on the planet are expected to make even more money. The market was never designed to be a thermometer for the people. It was always a thermometer for the corporations powerful enough to dominate it. And once that clicks, everything starts to look very different. Let's talk about something that most financial news will never actually explain to you. The S&P 500 is made up of 500 companies, right? So you'd think that when it hits a record high, it means those 500 companies are all doing well, and by extension, the broader economy must be thriving too. But that assumption is exactly where most people get misled, because the S&P 500 is not an equal playing field. It never was. The index is weighted by market capitalization, which means the bigger the company, the more influence it has over the entire index. And right now, a small group of mega-cap corporations, we're talking about just 7 or 8 companies, represents a disproportionate chunk of the entire index's value. So when those few companies perform well, the whole index goes up. It looks like a broad market rally. It feels like the economy is healthy. But underneath that headline number, hundreds of other companies might be struggling, stagnating, or quietly falling apart. This is where it gets personal. You're watching the stock market hit all-time highs on the news, and at the same time, your rent just went up again. Groceries are still expensive. Your paycheck doesn't stretch as far as it used to, and somehow none of that seems to slow the market down. That's not a glitch. That's not a temporary disconnect. That's the system working exactly as it was built to work, rewarding concentrated corporate power while regular people absorb the real cost of inflation and economic pressure. The market hitting records doesn't mean the economy is working for everyone. It might just mean a handful of the most powerful corporations on earth are having a great year. Here's something that will completely rewire the way you read financial news. Think back to school for a second. You walked into a test expecting to fail. You thought you were getting a D, but when the grade came back, it was a C. Technically, that's still a bad grade, but in that moment, it felt like a win. You were relieved, maybe even a little proud. Nothing actually improved, but your expectations shifted, and that shift changed everything about how you felt. The stock market runs on that exact same psychology. Markets don't just react to what happens, they react to the difference between what was expected and what actually occurred. If investors were bracing for catastrophic earnings, a war escalation, or a devastating jobs report, and the news comes in just slightly less terrible than feared, prices go up. Not because things are good, but because things weren't as bad as the market had already priced in. That gap between fear and reality is where rallies are born. This is why you'll see the market surge on a day when the headline news still sounds awful to everyone else. A company reports losing money, but less than analysts predicted, and the stock jumps. An inflation report comes in still high, but a fraction lower than expected, and the index spikes. It feels irrational from the outside, but inside the logic of market expectations, it makes complete sense. And here's where it gets wild. A single tweet hinting at a possible ceasefire in an active war zone can trigger a massive rally within minutes. Not because peace has arrived, not because anything has been resolved, but because uncertainty dropped by just 1 degree, and in financial markets, that's sometimes all it takes. Now let's talk about the invisible hand that quietly inflates everything: interest rates. When central banks cut rates close to zero, something very predictable happens. Saving money in a bank account stops making sense. If your savings are earning almost nothing, you start looking for somewhere else to put that money. And where does it go? Into assets, stocks, real estate, bonds, anything that offers a return. Multiply that behavior by millions of investors and institutions all making the same move at the same time, and you get a tidal wave of capital flooding into financial markets. This is exactly what happened after the 2008 financial crisis. Rates were slashed and kept near zero for years, and almost mechanically, asset prices climbed, not because the underlying economy was thriving, but because cheap money had nowhere else to go. Then the pandemic hit, and the same playbook ran again, only faster and bigger. Rates dropped to the floor, governments injected trillions into the system, and within months, markets were hitting all-time highs while people were still losing jobs and businesses were shutting down. But here's the part that rarely gets talked about clearly enough. When governments inject massive amounts of money into the economy during a crisis, that money doesn't land evenly. It flows through the financial system, and it tends to pool in the hands of people and institutions that already hold assets. So what do they do with it? They buy more assets, more stocks, more real estate, more of everything that's already going up in price. The result is a widening gap that keeps compounding itself. Those who already owned assets before the crisis walked out richer than ever. Those who didn't own anything watched prices rise on homes they couldn't afford, stocks they'd never held, and a market celebrating a recovery they never felt. There's a deeper reason why money keeps flooding into stocks, real estate, gold, and Bitcoin, and it has everything to do with a growing distrust in currency itself. Every time a crisis hits, governments respond the same way. They print more money. It happened in 2008, it happened in 2020, and each time they do it, the purchasing power of every dollar already in existence quietly shrinks. People with financial knowledge see this pattern clearly, and they make a rational decision. They don't want to hold cash that's losing value. They want to hold assets. And the numbers behind this distrust are staggering. The United States currently carries over $39 trillion in national debt. That's not a distant abstract figure. It costs roughly $3 billion per day just in interest payments. Every single day. When sophisticated investors look at that trajectory, they don't see stability. They see a currency under long-term pressure. So they move their wealth into things that can't be printed. Stocks, property, gold, Bitcoin. Assets with limited supply become a shelter when confidence in money starts to crack. But here's where the modern market adds another layer entirely. Today, a significant portion of all trading isn't done by humans at all. Algorithms execute billions of transactions in fractions of a second, responding to price signals, momentum patterns, and options positioning. And the options market creates a feedback loop that can turn a small positive move into something enormous. When prices nudge upward, market makers who sold call options are forced to buy the underlying stocks to hedge, which pushes prices higher, which triggers more algorithms, which forces more buying. What starts as a modest rally can become a runaway surge with almost no fundamental reason behind it. The machines don't care about the economy, they care about the signal. And once that cycle starts spinning, it's almost impossible to stop from the outside. Let's be honest about something that most financial content will dance around forever. No asset can rise exponentially forever. Gravity exists in markets just like it does everywhere else. What goes up on the back of cheap money, algorithmic momentum, and concentrated corporate power is not the same as what goes up because of genuine, broad economic growth. Those are two completely different things, and confusing them is exactly what keeps most people on the wrong side of the wealth divide. But here's the real shift in thinking that changes everything. The question most people ask when they see the market hitting records is, why is it going up? That's the wrong question. The question that actually matters, the one that reveals the entire structure underneath, is who benefits when it goes up, and the answer is uncomfortably clear. The people who benefit most from rising asset prices are the people who already own the most assets. The top 10% of households in the United States own over 90% of all stocks. So when the market gains $1 trillion in value, the overwhelming majority of that wealth lands in the hands of people who were already wealthy. This is not a glitch. This is the compounding engine of inequality running at full speed. Every time asset prices surge, whether it's stocks, real estate, or any other financial instrument, the gap between those who own and those who don't grows wider. Not slowly, rapidly. And the faster the market climbs, the faster that gap accelerates. The person watching the market hit records from a rented apartment isn't just being left behind. They're watching the distance between themselves and financial security increase in real time. You've just walked through the mechanics that most people never fully see laid out in one place. The concentration of index power, the psychology of expectations, the role of interest rates, the distrust of currency, the algorithms, and now the question of who actually wins. You understand something now that the average person consuming financial headlines simply doesn't. Understanding how markets work doesn't require a finance degree or years on Wall Street. It requires the right explanations delivered clearly without the noise. Everything you heard in this video, the index concentration, the psychology of expectations, the role of interest rates, the algorithms, the question of who really wins. This is the kind of knowledge that changes how you see the world every single time you read a financial headline. If you made it all the way here, this channel was made for you. Subscribe right now and hit the notification bell so you never miss a breakdown like this one. Every video we publish is designed to take complex economic and financial concepts and make them genuinely understandable for real people. Drop ICIT now in the comments. If something in this video shifted your perspective, it genuinely helps this content reach more people who need to hear it. Leave a like if this was worth your time. And the next video is already on your screen. Don't let it wait.